We're creating new challenges on the trade side that will have economic implications that will feed back to the financial markets.
Financial thought leader John Lipsky is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. How many times have you heard or read the words uncertainty and volatility to describe the markets in recent weeks? They have become the watchwords of Wall Street. Those same descriptors are being applied to the global financial system as well. Many of the agreements and institutions that have been in place since the post-World War II Bretton Woods Agreement in 1944 are being challenged by the United States, which was the primary architect of the then new international monetary system. In a recent interview on Wealth Track, Nick Sargent, author of Global Shocks, talked about the major impact President Trump's new tariff policies were having on the economy and markets. This week, we are addressing the international impact with an acknowledged global financial thought leader. He is PhD economist John Lipsky, Senior Fellow of the Foreign Policy Institute of Johns Hopkins University's School of Advanced International Studies, co-chair of the Aspen Institute's program on the world economy, and a member of many other prestigious policy organizations. Lipsky was first Deputy Managing Director of the International Monetary Fund from 2006 to 2011, having spent a decade there earlier in his career. He also worked on Wall Street as Vice Chairman of the J.P. Morgan Investment Bank and Chief Economist at two major financial institutions. I sat down with Lipsky on April 11th, the week after President Trump's Liberation Day announcement of the imposition of global tariffs and a subsequent moratorium on some of them. I asked Lipsky how Trump's policies are affecting the global trade and financial systems.
The first question is, what is happening to the world trading system, and how is that going to affect the financial system? And Consuelo, I think it's important to realize that in the wake of World War II, at the primary insistence of the United States and with guidance from the United States, we created a new trading system and a new financial system that were designed to be mutually supportive. Because the idea was, the recognition was, that the collapse of the international financial system and the collapse of the international trading system is what made the Great Depression and helped usher in World War II. At the end of the war, what we had was the ruins of a financial system and a highly protective and isolating trade system. So the idea was to create first the General Agreement on Trade and Tariffs that was designed to reduce tariff barriers and reduce and open markets, international markets. Simultaneously with the creation of the International Monetary Fund, which, when you look at the constitution of the fund, which is the Articles of Agreement, it says the goal is to encourage and support the rapid growth of international trade that would produce the impetus for a reacceleration of global growth and to sustain global growth. So it was designed initially with the idea that if we can remove trade barriers and create an efficient and reliable and resilient international financial system, what would be produced would be a rapid growth in trade that would encourage rapid growth in the post-war global economy. And that's exactly what happened. In other words, from 1950 to 2007, international trade grew more rapidly than international GDP. In other words, trade continued to grow, obviously from a low base, to a higher and higher percentage of the global economy. But that also was the period of the fastest growth, sustained growth in the global economy, probably ever in history, ever. Then came the global financial crisis. In November 2008, a new institution appeared, which was the Group of 20 Leaders Summit. They gathered in Washington and agreed on 4 agenda items to get out of the global crisis. One of them was no new protective barriers, and in fact, an agreement to implement what was called the Doha Development Round, a new multilateral trade liberalization under what was now the World Trade Organization, the successor to the earlier GATT. What's happened? Was that lived up to? Absolutely not. First of all, the Doha Development Round was simply abandoned. Secondly, hundreds and thousands of small protective measures were implemented. From 2007 to today, trade has grown more slowly than global growth. And not only that, this has been the slowest period of global growth since World War II. In other words, instead of living up to our ideals already in the wake of the global financial crisis, the world started to implement new protective measures. Now, what President Trump has proposed is something that people may sound logical, the so-called reciprocal protection. And the idea is, what you do to me, I'll do to you. Isn't that fair? And the answer is, well, I don't want to know about fair or not fair. It doesn't make much sense for a couple of reasons. The primary basis of the post-war trade liberalization was something called most favored nation policy, which is, for a member of the WTO, if they granted trade liberalization to one member, they had to grant it to all. It was to create an open, non-discriminatory international trading system, a level playing field. Obviously, there are issues. It's not perfection, but that was a key guide. Now, if the idea is reciprocal, that means I now discriminate. Different protection for the same product from different places. That's not non-discriminatory. And secondly, if the policy is, I'll do to you what you do to me, that means, oh, the other country gets to decide my policies, because whatever they put, I'm going to mimic them. You stop and say, wait, wouldn't I want to create my policies that are in my interest? Why should I just mimic what somebody else does? And moreover, when you think about trade, do two countries tend to trade the same product? So if I'm importing X from country Y, we probably don't trade the same things.
I used the example with Nick Sargent, your good friend, recently on a previous Wealth Track, of the banana. and the fact that we don't grow a lot of bananas in the United States, but there are countries that do, and so we import a lot of bananas from them. That is to our benefit. So multiply that thousands of times in products.
And not only that, when you take the International Trade Code of the United States, there are 13,000 line items by 200 countries. So does that mean that we have hundreds of thousands of different tariffs set on the basis of, well, so you can see the notion of what they really came up with wasn't reciprocal at all. So we end up with a basic question that doesn't seem to have been discussed. Does that mean the United States is abandoning the notion of most favored trade relations? Does it mean the U.S. is now walking away in many ways from the World Trade Organization that the U.S. was instrumental in creating in order to produce a system that would approximate a level playing field? So it appears that we are taking steps to undermine the pre-existing international trading system that we helped create and produced this excellent result. Not perfect, but compared to the past, excellent result up until the global financial crisis.
when the global financial crisis happened, where you happened to have a key role at the IMF during that crisis, so you were right in the thick of things. What changed with the global financial crisis?
We came very close to approving Doha.
Right.
But it turned out there were some large developing countries that in the end worried that it wasn't sufficiently favorable to them, and they refused to go along. In the midst of the Great Recession at the time, there was just too much domestic pressure to undertake nothing on the scale of what's being proposed now in terms of protection, but more minor protective measures. But now it's happening in leaps and bounds from the U.S. side. But that hasn't stopped other countries and other areas from continuing to negotiate trade liberalization. For example, after many years, the European Union has agreed on a new trade agreement, trade liberalization with Mercosur, a group of Latin American countries. So whereas the U.S. has very clearly moved now away from the old standards, away from free trade agreements or liberalization of trade, opening markets, and in favor of this new and unclear set of policies, that doesn't mean the rest of the world has decided that they also want to adopt greater protection among themselves. So one of the big questions not only is, well, what is the U.S. going to end up doing? What is the goal of U.S. trade policy initiative? Is it protection? Is it actually the reverse, to force others to negotiate less protection? Treasury Secretary Besson has said to escalate to de-escalate, but others have said no, protection is beautiful. Tariffs are beautiful. So there's uncertainty about the U.S. initiative, even though the U.S. initiative is huge in scale.
The United States is a service economy. The largest percent of GDP comes from services, not from manufacturing. If you were to include the services aspect, what we export as services, and give me some examples, it would be a very different picture, right?
Of course it is. For example, we have a trade deficit in goods with the European Union, but a surplus in services exports to the European Union.
And services such as?
Financial,
banking,
tourism, technology, software, etc. All kinds of new services. And we know in our own economy, we're looking forward to some big changes associated with high technology. This technology that is potentially universal and useful universally. Right now, U.S. firms are taking the lead.
In AI, for instance.
For example. And what we've already heard from Europe is if we're going to be erecting big trade barriers with regards to goods, Europe will consider erecting new trade barriers with regards to services. And if the end goal is that we're going to have a base of 10% tariff on everything from everybody, that's a huge increase in tariffs relative to what we have today. And it's evident, as you can see, Consuelo, that investors have determined that even though there's lack of certainty about what actually is going to happen, that odds favor a more inflationary environment. And that has, as we've seen already, financial market implications.
Looking at what's going on in the markets, which are changing minute by minute. You and I are talking April 11th. Who knows what's going to happen? John, tell me what you think the financial markets are telling us.
If we can take a step back where we started. In 1950, 2007, rapid growth in trade, relatively strong growth in global output, in GDP. 2007 to 2024, slow growth in trade, slow growth in global GDP.
markedly more protectionism around the globe.
And if now there's going to be a big step up in protection, for example, on the U.S. side, you would have to imagine that the near-term response is going to be a decline in trade. What do you think that's going to do for global growth? Chances are, and I think so, investors are thinking the world's going to be more inflationary and growth's going to be slower, and there's going to be a lot more uncertainty and hence volatility. There are a number of things we can say that financial things that spin off that. Number one, if this means higher interest rates, slower growth, and greater volatility, there are a lot of developing economies that are already at the border of debt problems, and we could see many more. In a situation in which the pre-existing system, the so-called Paris Club system, for renegotiating sovereign debt of emerging market economies is currently not working. There needs to be new international agreement on how to deal with these kinds of problems. And it looks like we're headed for a kind of environment that if we don't work quickly and with some success and some vision, those kind of problems are going to be more difficult than we have in the past. There's the issue of crisis resolution. Debt restructuring is crisis resolution. The crisis comes, the debtor defaults or can't pay, negotiation, that's crisis resolution. What we saw in the global financial crisis was a need for crisis prevention. And what's clear also is that the current system lacks effective mechanisms for crisis prevention. So the environment tends to build more uncertainty unless we can take new steps, both in terms of policy and creating facilities that would tend to enhance the possibility of crisis prevention. There are two other big aspects that are worth mentioning in this, talking about international financial markets. One is reemergence of large global imbalances and the implication that there have been very large cross-border capital flows. In the wake of the global financial crisis, the Group of 20 created the Financial Stability Board in an attempt to help create a more level playing field in terms of regulation, supervision, and rules in international financial markets. I think there's been progress, but at the same time, as we've seen in our own economy, there's been a huge increase in the complexity of financial markets, in the source of funding, and an easy way to put this is in the growth of the importance of non-bank financial intermediaries. And so questions raised about, well, how stable is that financial system that's structured very, very differently?
Private credit, private loans.
Among other things, private credit,
Okay.
yes. And that's probably the best way to put it. Private credit, securitized credit, more complex forms of finance, including internationally. So far, as we all know, the dollar has remained the international reserve currency, and in part because U.S. financial markets have retained credibility and depth and resilience. And that can't be taken for granted forever either. We're creating new challenges on the trade side that will have economic implications that will feed back to the financial markets that we need to be attentive to. And what we can't do is simply take for granted that everything's going to continue to be the way that we know it now.
So have the Trump trade policies, this dramatic change in tariff policy, has that spilled over to the financial system that you're talking about?
What we don't know, and we haven't seen, I'm repeating myself, our own goals of U.S. policy are not clear. And it's hard to foresee, therefore, our trading partners' reaction. And therefore, of course, it's hard to understand with clarity today what are things going to look like 2, 3, 4, 5 years from now. All of that is creating uncertainty in financial markets, and uncertainty in a negative way, which threatens to supplant where we were only months ago, when we were looking forward and thinking, could there be a technological, a wave of technological innovation that is going to produce greater productivity growth, that's going to produce stronger growth, that would tend to produce lower prices, and et cetera. We saw stock markets go to record highs based on that kind of optimism. And all of a sudden, we've turned that around to a point in which instead of, well, we don't know the future, but it looks pretty good, to we don't know the future and it's got a lot of risks and a lot of danger.
It is a new world. You know, we always ask the one investment question. Is there any place in the world or sector or asset that you would say you might want to look at, talk about investing there?
Where have there been changes engendered by this crisis so far that potentially look positive? One is for sure Europe, that it's produced, it looks like, changes in favor of greater unity. That could have implications in the financial markets if it moves forward the so-called banking union and capital markets union in the context of much more aggressive public policy in terms of infrastructure investment and defense. That's a positive. But of course, markets, if you look, have already picked up on that one. Is this going to be an environment in which are we going to have enforced something or have created incentive for something we may not have wanted, which is also greater unity in Asian economies? And if there's a sense of defensive need on the part of the largest Asian economy to cooperate in a way that they haven't, that could be interesting from an investment standpoint. Maybe not the way we would have wanted from a U.S. Point of view. But
so you're talking about China, for instance, President Xi going to Vietnam, for instance, or...
Well, for sure there, but the question, of course, is Korea, Japan, and China, as well as the countries of ASEAN.
Law of unintended consequences.
I take a step back and look and say, we had a system that was working for 60 years, and we've seemed to have moved away from it. Maybe it's time to think in terms of how we recreate or re-strengthen a system that is based on cooperation, on rules that apply to all, to a system that is open, non-discriminatory, multilateral, efficient, and fair. I think it's too early and too easy to give up on something like that.
Why do I get a sense that you and others like you are working on creating such or rebuilding such a system? I hope you are.
We're doing what we can.
John Lipsky, always a treat to have you on, and really an honor to talk to you, John. You've had such incredible experience and perspective and have made so many contributions to a better world order. So thank you so much, John Lipsky, for joining us.
You're too kind, but it's always a pleasure to talk to you, Consuelo. Thank you so much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is Read Manias, Panics, and Crashes, a history of financial crises. First authored by Charles Kindleberger when published in 1978, The book has been reissued many times since with updates and edits by noted economist and WealthTrack guest Robert Aliber, and most recently with Robert McCauley. It is now in its 8th edition. This investment classic has never lost its relevance because financial crises occur with disturbing regularity. In a most entertaining fashion, it analyzes the universal elements of how the mismanagement of money and credit has contributed to financial crises over the centuries. Next week, top-performing value investor Susan Byrne, founder of Westwood Management, joins us with her enduring approach to unsettling times. Please follow us on Facebook, X, and our YouTube channel. Thank you for spending your precious time with us. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.